Right now, the largest technology companies on Earth are on track to spend $725 billion on artificial intelligence infrastructure this year. To put the scale of that capital into perspective, that is roughly $23,000 being spent every single second. Scroll through financial news, and you'll find two completely opposed narratives. Half the market claims artificial intelligence is the greatest technological leap since electricity. The other half warns we are sitting on the largest financial bubble in human history. The reality is a stealth crash, a process where value is pulled away through the boring parts of life, like rising utility bills and stagnating retirement fund returns, rather than a loud market collapse. The smartest institutional players on Wall Street are already actively buying insurance against these exact AI companies failing. At the same time, they are aggressively recruiting new capital to keep the system running. That new capital is you. If you hold a 401k, a standard pension, or an everyday index fund, your retirement is the collateral secretly funding this high-stakes casino. To see exactly how this machine breaks, we have to look at South Korea. 14 million retail investors there, known locally as ants, borrowed heavily against their personal salaries to enter the tech market. They funneled that leveraged cash almost exclusively into two companies, Samsung and SK Hynix, the core suppliers of memory chips for AI data centers. When American tech stocks experienced a minor dip, it triggered a massive 10% single-day crash in Korea, now known as Black Tuesday. The KOSPI index dropped 25%, wiping out 1.2 million retail accounts in exactly 21 days. When you invest with borrowed money, a drop in stock price triggers an automatic margin call, a demand from the broker to immediately deposit more cash or face forced liquidation. In Korea, this created a doom loop. Automatic liquidations drove stock prices down, which triggered even more margin calls, wiping out over 3 trillion won in investments before human beings could even react. South Korea functions as a high-speed, concentrated version of the exact same leverage machine currently operating across the global AI sector. This chart shows American margin debt as a percentage of GDP, comparing today's levels to historical peaks. Right now, that debt sits at 4.5%. Today, artificial intelligence companies are attempting to bypass this cycle by manufacturing the appearance of demand. They are moving money in a giant circle. NVIDIA, for example, provided funding to OpenAI, who then used those funds to purchase NVIDIA's chips. This closed financial loop validates Wall Street narratives, but masks a staggering reality. OpenAI lost $21 billion in a single year. Eventually, the executives of trillion-dollar companies have to face the math. Spending hundreds of billions on data center infrastructure is difficult to sustain when actual financial returns on those AI tools are dropping beneath the surface. When this correction hits the United States, it will not look like the prolonged systemic banking collapse we watched on the news in 2008. Financial markets now operate through AI agents and algorithmic trading software that manage institutional portfolios without human emotion. These systems generate steep, parabolic climbs followed by immediate, brutal sell-offs. We saw a preview of this recently when the tech momentum factor experienced a massive 40% algorithmic unwind. That entire collapse happened in just 18 days. Modern financial markets have evolved to move faster than human reflexes. When the algorithms decide to exit, the unwind is instantaneous, leaving ordinary retail investors trapped holding the bag. To temporarily delay that unwind, brand new money is being injected from sovereign wealth funds in oil-rich nations like Saudi Arabia and Abu Dhabi. While that private capital keeps the machine humming, the major tech giants compensate for losses by letting middle-class 401k stagnate and allowing domestic utility bills to rise as they cover the energy costs of their data centers. But here is where the narrative shifts. Despite the financial engineering and the incoming market corrections, the underlying physical demand for global computing power is entirely real. That demand remains insatiable, and it will only grow as billions of new digital AI agents enter the ecosystem. Many market experts view these aggressive market drops and speed crashes not as a permanent failure, but as a necessary digestion period to shake out the heavily leveraged gamblers. There is an old axiom in venture capital. In every technology boom, the pioneers who take on extreme leverage to build the initial infrastructure are almost always the ones who end up with arrows in their backs. The true winners are the settlers. They are patient investors who wait out the stealth crash, watch the heavily leveraged risk-takers get wiped out, and then step into the wreckage to buy the foundational infrastructure of the future for pennies on the dollar.